Hello everyone, hope you are fine and doing well. We will start this week chapter of risk and return and the capital asset pricing model. This chapter will be divided into four parts as it's long chapter and contains many topics. During this week, we will start the first part, four lectures of Monday and Wednesday. Part 1, risk and return of one asset. To take any financial decision, you have to take into consideration two important concepts or things, which are risk and return. Remember with me, at the beginning of this course, we said that there are four important principles of finance, and one of these principles is the trade off between risk and return. And we said that these concepts are very important in finance. Consequently, the main objective of the investor is to maximize the return for his or her investment. But the investors have to take into consideration the existence of risk. Before starting calculating risk and return of one asset, there are general concepts we have to know. First, risk. Risk is the variability of returns that are expected from investments. For example, I am an investor and I want to invest my money in a specific investment. I expect to take rate of return. This is expected rate of return. But at the end of the investment, I can earn more or less than this expected return. In this case, it's the actual return. The difference between actual return and expected return is the risk. Therefore, we can say that the risk is the measurement of unexpected changes of investment returns. It's the measurement of uncertainty. The higher the uncertainty of the investment return, the higher its risk. Second, return. Return is the total gain or loss incurred by the investment during a specific period of time. And I said here gain or loss. So the return can be negative or positive. Not all the time that the investor takes gain or takes profit. Sometimes he can take loss. Types of investors. There are three types of investors: risk averse investor, risk lover investor, and risk neutral investors. We will take or talk about each one of them in details. First, risk averse investor. We can also say conservative investor. This investor, if he chooses between two assets with the same rate of return, he will select the asset with the lower level of risk. Second, risk lever investor or aggressive investor. If this investor chooses between two assets with the same rate of return, he will select the asset with the higher level of risk. Third, risk neutral investor. This investor, if he chooses between two types or two assets with the same rate of return, it's indifferent for him to select one of them. Portfolio theory assumes that investors are risk averse, so all financial decisions depend on this fact that the investors are risk averse. Before studying the measurement of risk, you should remember the concept of variance. Did you remember variance in statistics? Variance is used as a measure of the dispersion of a set of numbers. It's one of several descriptors of probability distribution, describing how far the numbers lie from the expected value. And we will use the concept of variance and standard deviation to measure the risk. How to calculate the risk and return of one asset. We will start with determining the expected return of one asset. This is the rule. R bar equal summation from I equals 1 to n Ri by Pi. What are these abbreviations or these characters? R bar is the expected return for the asset I want to calculate. Okay? Ri is the return for the ith possibility. He will give me in the problem different possibilities of returns and the related probability of each one of them. Okay? And I will multiplying both of them and adding all the possibilities to get the output. Okay, we will illustrate this on the example to be more clarified. This is an illustrative example. I have a stock BW and this stock has different possibilities of occurring returns and the related probability of them. يبقى أنا عندي هنا returns مختلفة ممكن إنها تتحقق في الشركة دي أو اتحققت بالفعل في previous years related واحتمال إنها تتحقق أو ال probability of occurring these returns إيه هي. Okay, for example, the first possibility negative 0.15 or negative 15%. In this case, this stock incurs loss and the probability of this loss is 0.1. The second possibility is negative 3% and the probability of happening of this or occurring of this loss is zero point 0.2. The third possibility is 9%. It's a gain or it's a profit. And the probability of occurring this return is 0.4 and so, okay? We know that the summation of PI or probability at the end is 1. So to calculate or to find the R bar, I have to multiply each possibility by each related PI. So at the first row, I will multiply negative 0.15 by 0.1. In the second row, I will multiply negative 0.03 by 0.2. In the third row, I will multiply 0.09 by 0.4. In the fourth row, I will multiply 0.21 by 0.2. In the last row, I will multiply 0.33 by 0.1. Okay? And I will adding all the results of multiplication to get the output. It's equal 0.09 or 9%. Okay? Second, defining risk. The variability of returns from those that are expected is the risk. What are rate of return do you expect in your investment this year? And what or will you actually earn? The difference between them is the risk. There are two types of risk, systematic risk and unsystematic risk. What's the difference between them? First, systematic risk or non-diversified risk or market risk. All of them are the same. It's caused by macroeconomics variables such as volatility of money supply or interest rate. This risk can't be avoided by diversifications. I mean, in this kind of risk, that all firms are affected by this type of risk. For example, any changes in the money supply, in the interest rate, in the inflation, exchange rate, all these variables affect all firms, not only specific category of firms. So I can't avoid this type of risk by diversification of my portfolio. Okay, put some assets and ignore some assets can't help me to avoid this type of risks. The second type of risks is unsystematic risk. It's a unique risk caused by the business conditions of some firms. For example, if some firms have a worker strike, in this case, this is related to these firms only, not all the firms. Okay, so I can eliminate or reduce this type of risk by diversification, by not putting these assets of these firms in my portfolio. Here, we want to ask ourselves a question. Do I have only one measurement for risk? Actually, not. I have different measures or measurements for risks. Beta coefficient is used to measure the systematic risk, but standard deviation is used to measure the total risk, systematic risk and non-systematic risk. So it's more cautious. Also, I have coefficient of variation. I can use the coefficient of variation to measure the total risk. Two ways to measure total risk for an asset: standard deviation and coefficient of variation. And we will take the rule of each one of them in details in next slides. How can I calculate the standard deviation as a risk measure? Standard deviation, sigma, is the square root of variance and is a statistical measure of the variability of a distribution around its means. And we said before that the risk is the variation or the variance from the expected return. Okay, so I think we can use standard deviation to measure the risk. The rule of the standard deviation is sigma equals the square root of summation from I equals 1 to n, Ri minus R bar square multiply Pi. We said before that Ri are the all possibilities of occurring different returns of the stock or the assets. R bar is the expected return of that asset. And Pi are the all probabilities related to different possibilities. Okay? We will apply this on the next example. This example is related to previous example when we calculated the R bar. Stock BW, I have here different possibilities of occurring different returns, and I have the related probabilities of these possibilities. Okay? I calculated the R bar by multiplying each possibility of return by the related probability. For example, negative 0.15 by 0.1 equals negative 0.015. Negative 0.03 by 0.2 equals negative 0.006. 0.09 by 0.4 equals 0.036. 0.21 by 0.2 equals 0.042. And finally, 0.33 by 0.1 equals 0.033. And after that, I will add all the numbers in the third columns together to find the R bar. Look at the first column of the table. We find some numbers are negative and some are positive. As we said before, the return can be negative or positive. ممكن الشركة تحقق profit or loss. Why did we calculate R bar in the standard deviation? Because the rule of the standard deviation will depend on R bar. طيب الفورث column ده النمبرز اللي فيه جت منين؟ This is the rule, okay? ده الفاينل نمبر او الفاينل results, okay? لكن دي جت منين؟ هنقول كل نمبر من دي جه منين دلوقتي, okay? طيب the first number in the fourth column equals negative 0.15 minus 0.09 squared by 0.1. The second number in the fourth column equals negative 0.03 minus 0.09 squared by 0.2. The third number in the fourth column equals 0.09 minus 0.09 square by 0.4. بس طبعا 0.09 minus 0.09 equals 0 فعشان كده طلع 0 من غير السكوير ومن غير ما نضربه في البي ار. The fourth number in the fourth column equals 0.21 minus 0.09 square by 0.2, and the last number in the fourth column equals 0.33 minus 0.09 square by 0.1. So I will add all the numbers in the fourth column to find the summation of them اللي هو 0.01728. Is this the standard deviation? No, it's not the standard deviation. The standard deviation is the square root of this number. Okay? يبقى المفروض نجيب ال square root of this number to find the standard deviation, which is 0.1315 or 13.15 عشان احنا multiply by 100 to find the percentage. From the previous example, we can say that the higher the standard deviation, the higher the return variation, and the higher the risk of investing in this asset. Okay? كل ما بيزيد ال standard deviation معنى كده ال deviation أو ال variance from ال expected return بيزيد، فمعنى كده إن ال risk كبيرة. Coefficient of variation or CV. We said before that we have two measurements of risk, coefficient of variation and standard deviation. Which one is better? Sometimes using standard deviation give us misleading results to compare between two assets or two investments because standard deviation doesn't take into consideration the related expected return, but coefficient of variation shows the risk per unit of return because it equals sigma or standard deviation over R power. So it takes into consideration the R power. Okay, it's more benefit or it's more meaningful in comparison between assets or between two alternatives. The investment with lower coefficient of variation means this investment has lower risk and will be more attractive. This is an illustrative example. I have two assets, asset 1 and asset 2. The first asset, the expected return is 24%, the standard deviation is 8%. The second asset, the expected return is 8% and the standard deviation is 6%. Which one is better? Which one I have to choose? Okay. احنا قلنا قبل كده depending on the risk aversion, when I have two assets with the same rate of return, I will choose the lower risk. لكن هنا ال expected return different فمش هنعرف نقارن بناء على كده. Therefore, I have to calculate the coefficient of variation to be able to choose one of them, the better of them. The coefficient of variation, which is sigma over R bar, equals for the first asset 0.33. The second asset 0.75. And we said that the investment with the lower coefficient of variation means that these investors have the lower risk and more attractive. So I will choose asset 1. على الرغم من asset 1 لو انتوا شفتوا عنده الستاندرد ديفيشن اللي هو الريسك عالي، لكن احنا لو اعتمدنا على الستاندرد ديفيشن هيدينا misleading results. So we have, in comparing between two assets or two portfolios, we have to depend on the coefficient of variation, not the standard deviation. Standard deviation is the previous step, and I have to follow this step by calculating the coefficient of variation. At the end, we can conclude that there is a positive relationship between return and risk measured by standard deviation. When we talked about the four principles in finance, we said that there is a one of the principles say that there is a trade-off between risk and return. To increase risk, you have to increase return to compensate the higher risk. So if the investors want a higher return, they should burden a higher risk. This is the end of part one of this chapter. I hope you benefited from the recording, and if you need any help and any question, don't hesitate to contact me by mail and I will reply as soon as possible. And also, if you have any comments regarding the recording, the voice, the speed, anything, don't hesitate to contact me. See you soon and goodbye.